Is paying full price for 100 shares of Microsoft really the smartest move you can make? Stick around, because the answer might surprise you. Here's the catch. Locking up $20,000 in a single stock absolutely kills your flexibility. That cash is stuck, and it can't work anywhere else. And what about margin? Sure, it frees up capital, but you're paying interest every single day. Plus, there's the constant threat of a margin call hanging over your head. Today, we're breaking down a tool that Wall Street insiders love. It's called Deep in the Money Leaps. With this strategy, you control 100 shares using just a fraction of the cash. And at the same time, you cap your downside. The core idea here is called the stock replacement strategy. Let me show you how it works. Instead of tying up 100% of your capital buying the stock outright, you spend just 30 to 40% of it on a deep-in-the-money call option. Yet you still get nearly the same profit and loss as owning the stock itself. Almost identical exposure for way less money. And the leftover cash, it stays right there in your account, earning interest or funding other opportunities. This strategy comes with 3 big advantages. First up, massive capital efficiency. Second, it's interest-free leverage. You never borrow a single dime from your broker. And third, your downside is hard capped at the premium you paid. Never, ever more than that. Now, before we go further, you need to understand 2 key concepts. Concept 1. Leaps. These are long-term options. Regular options expire in days or weeks. And time decay? It eats them alive. But leaps are different. They run 1 year, 2 years, or even longer. That gives you a huge cushion of time to wait for the stock to deliver. Concept 2. Deep in the money. And to understand it, you need to know a Greek called delta. Delta measures how tightly your option tracks the stock price. Think of it as your option's sensitivity. An at-the-money option? That has a delta of around 0.5. It only captures about half the stock's move. But for stock replacement, we only want a delta of 0.8 or higher, nothing less. Here's what that means. At a delta of 0.85, when the stock rises $1, your option gains 85 cents. And since one contract covers 100 shares, it's basically like owning 85 shares of the stock. Want proof this works? Just look at the Pelosi family's public trading records. Before the last tech bull run, Paul Pelosi bought long-dated call leaps. He targeted Nvidia and Microsoft, and he set the strike prices extremely low. As prices exploded, the built-in leverage absolutely crushed plain stock returns. And the best part? He did it all without paying a single cent of margin interest. But here's the warning. That same family got burned badly on Roblox. Their mistake? They used a blue-chip strategy on a speculative, unprofitable stock. When Roblox crashed 50%, regular shareholders could simply hold and wait it out. But options don't work that way. Options expire, no matter what. Those once deep-in-the-money leaps got knocked out of the money. And the position went straight to zero, a total loss. So here's the lesson. Only bet on assets that can keep making new highs. That means elite blue chips and broad index ETFs only, never volatile junk stocks. Now, let's do the math together. Say a stock trades at $200 a share. Buying 100 shares would cost you $20,000. That's a big chunk of capital. Step 1. Open the options chain and pick contracts expiring beyond 1 year. Step 2. Find a strike with a delta between 0.8 and 0.85. Let's say that's the $150 strike with a delta of 0.82. Step 3. Calculate your true time cost. This option is quoted at $60. That works out to $6,000 per contract. Now, here's the pro formula. Extrinsic value equals the option price minus intrinsic value. So that's $60 minus $200 minus $150. Your time cost is just $10. That $10 is your real cost. The other $50 is pure intrinsic value. You're not paying for that. You own it. So, for $6,000, you control $20,000 worth of stock. Let that sink in. And your break even? The stock just needs to pass $210 within 18 months. Finally, the 3 iron rules. Rule 1. Stick to top blue chips or broad index ETFs. No exceptions. Rule 2. Always use limit orders. Wide bid-ask spreads will eat you alive if you don't. Rule 3. Roll early. When 60 to 90 days remain, time decay accelerates fast. So sell the old contract and roll into a fresh 1-year leaps. Stay ahead of the decay. Bottom line, this strategy isn't gambling, it's precision capital allocation. You get the same long-term upside with far better liquidity and risk control. And if you want to take it further, there's the poor man's covered call. That's where you sell monthly calls against your leaps. Want to learn it? Drop "Want PMCC" in the comments below. And remember, this video is for educational purposes only, not financial advice. See you in the next one.